Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
All right, Steve. Let's kick off today's discussion with an interesting trend we're seeing in the mortgage market here in Canada. Earlier this year, variable rate mortgages were all the rage. Folks were banking on further interest rate cuts from the Bank of Canada, and they seemed like a promising option. But as we approach the end of the year, it looks like the tide is turning back towards longer-term fixed rates.
Yes, Andy, that's right. The shift is quite notable. There's not much difference right now between variable rates and 5-year fixed rates, but it seems like the security of those longer-term fixed rates is really appealing to people. According to Taz Zaid from Six Mortgage, the economic turmoil expected in the coming years is a big factor. Plus, the Bank of Canada has hinted that we're nearing the end of its rate-cutting cycle.
It's interesting how quickly things can change in the mortgage market. Zaid mentioned that while we expect variable rates to stay stagnant, there's always the possibility of unforeseen events that could lead the rates to drop even further. It's a bit like trying to predict the weather, isn't it?
Exactly, Sandy. Zaid advises clients to remain cautious and reactive. The market is volatile, and while the projections suggest stability, anything could happen that might throw those predictions out the window. It's important for borrowers, especially those renewing their mortgages, to stay informed and be prepared for any shifts.
And for those whose mortgages are up for renewal soon, it seems there might not be much relief on the horizon, at least not on the variable rate front. But it's not all doom and gloom. Zaid points out that many who took out a mortgage in 2023 could actually see their payments decrease due to interest savings.
That's a silver lining, Sandy. And while the current borrowing costs might not be enough to kickstart the housing market just yet, Zaid suggests that we might see some movement early next year. It's typical for the market to pick up around mid-January, so it'll be interesting to see how things unfold.
All right, Steve. Let's delve into this recent poll revealing that nearly 80% of people in Ontario aren't considering buying a home even with the recent interest rate cuts. Despite home prices dropping in the Greater Toronto area, it seems like there's still a lot of hesitancy among potential buyers.
Yes, Sandy. The Toronto Regional Real Estate Board report highlighted a 5% year-over-year dip in the composite benchmark for October 2025, and the average selling price has decreased by 7.2% compared to last year. With borrowing costs also down, you would think these factors would encourage more people to buy.
You'd think so, but according to the poll conducted by Insaga.com, a significant 77.19% of respondents said they wouldn't consider buying a home even with the lower interest rates. That's quite telling, isn't it?
It is, Sandy. The Bank of Canada lowered its benchmark interest rate to 2.25%, with a second consecutive cut at the end of October. Yet despite these reduced borrowing costs, it seems the economic conditions and tariff threats are influencing buyer sentiment more heavily than anticipated.
And it's interesting to note that Royal LePage's market report indicates national home prices have come down by approximately 5% since the peak of pandemic pricing in spring 2022. But it seems that improved affordability hasn't been enough to sway potential buyers.
Right, and BMO senior economist Robert Kovcich mentioned that another quarter-point cut could be on the table for early next year. However, even with potential future cuts, it seems there's still a lot of caution among buyers due to economic uncertainty.
Phil Soper, president and CEO of Royal LePage, attributes this hesitation to a mix of economic and psychological factors. He points out that many Canadians, especially younger ones, are cautious because of high post-pandemic living costs, perceived job uncertainty, and general unease about economic prospects.
Yes, And while Soper expects stronger buying activity by the spring, it's clear that current buyer sentiment is heavily influenced by these broader concerns. It seems understandable that many are waiting before making such a significant purchase.
All right, Steve, let's dive into the latest updates on Canadian investor mortgage regulations, which have been delayed but are finally set to take effect in 2026. The Office of the Superintendent of Financial Institutions, or OSFI, will be treating investor mortgages as riskier assets. This move aims to reduce liquidity for mortgages on non-owner occupied homes.
Yes, Sandy, this change was originally scheduled for 2023 as part of Canada's adoption of global risk standards. These standards are meant to limit the use of internal models that can sometimes downplay threats and hide systemic risks. The impact will be felt across all markets, but those dominated by investors will be hit the hardest.
The Basel Accords, which include Basel III, are international agreements designed to improve global banking oversight. After the global financial crisis, Basel III was introduced to limit future shocks by forcing banks to properly assess risks and hold adequate capital against those risks.
That's right, Sandy. A key feature of Basel III is the standard output floor, which sets a global minimum based on risk-weighted assets. This means riskier loans require more capital to back them. For Canadian mortgages, OSFI is introducing a new classification called income-producing residential real estate. This classification will assign a premium to investor mortgages, acknowledging their higher risk, especially after the speculative boom we've seen.
So, investor mortgages of similar terms to owner-occupied homes will carry a 45% risk weight compared to 30% for owner-occupied homes. This makes the loans more expensive for lenders to hold, which could translate into higher borrowing costs for investors or reduce leverage.
Exactly, Sandy. While it might seem like OSFI is targeting investors, this move actually benefits end-user homebuyers. By separating investor mortgages from those of owner-occupiers, lenders can offer more favorable terms to people who actually live in their homes. Originally, these changes were set to take effect after the rate-driven investor frenzy, but the unexpected collapse in prices and demand delayed the response.
OSFI has recently broken their silence, slipping details into an annual update. The 2026 capital adequacy requirements are set to take effect on January 1st, 2026, with banks preparing for changes by the second quarter of that year. However, whether this timeline holds remains to be seen.
Yes, Sandy, the delay has allowed for more liquidity in the investor mortgage segment, which has arguably contributed to the current real estate rut. By postponing the risk weighting, banks have made accommodations that might not have been sustainable in the long term.
And assuming there are no further delays, the impacts are clear. Investor liquidity will shrink, leverage will fall, and financing costs will rise for non-owner occupied homes. Markets heavily reliant on investor borrowing will feel the squeeze more than those focused on end-user buyers.
It's interesting to consider whether this delay was entirely OSFI's decision or if other influences were at play. Regardless, it's clear that the real estate market is facing significant changes ahead.
Ontario's government is stepping in to take control of the Real Estate Council of Ontario, or RECO, after the fallout from the iPro Realty scandal. This intervention comes as a response to a damning audit that criticized RECO's handling of the situation. The audit, conducted by Dentons Canada LLP, revealed significant mishandling by the former registrar, who failed to freeze iPro's accounts or promptly notify the board, leaving consumer deposits and commissions vulnerable for several months.
It's a rare move, Sandy, for the government to appoint an administrator to a regulatory body like RECO. Public and Business Service Delivery Minister Stephen Crawford emphasized the seriousness of the situation in a letter to RECO's board, stating that appointing an administrator is necessary to prevent harm to the public and restore confidence in the organization. Crawford has given RECO 15 days to respond before making a final decision.
The iPro Realty case is indeed troubling, Steve. Reports indicated that approximately $10 million went missing from trust accounts, marking the largest shortfall in RECO's history. Despite this, no charges were laid, and the brokerage continued operations for 4 months before its closure. The Denton's report also highlighted a potential bias, noting that one of iPro's principals was a former RECO board member. Although no improper influence was found, the registrar's failure to follow standard protocols and the inclusion of a non-prosecution provision in the agreement with iPro's principals raised serious concerns about public trust.
Industry leaders are backing the government's decision. Kathy Pollan, president of the Ontario Real Estate Association, and Alekia Barrie-Sproul, president of the Toronto Regional Real Estate Board, issued a joint statement supporting the appointment of an administrator. They stressed the need for RECO to refocus on its consumer protection mandate and expressed their commitment to working with the government on reforms to enhance transparency and accountability in Ontario's real estate market.
It's clear, Steve, that the call for independent oversight of RECO has been growing. In September, the Ontario Real Estate Association and its 9 largest member boards demanded such oversight, highlighting the need for reforms to ensure the regulator can effectively protect consumers. This intervention by the government could be a step towards achieving that goal.
Absolutely, Sandy. The next steps will be crucial in determining how RECO can regain public trust and ensure its operations align with its mandate. With the potential appointment of an administrator, there's a real opportunity here to implement meaningful changes that could fortify the real estate market's integrity in Ontario.
Moving on to our next topic, Steve, let's discuss an exciting new development in Barrie, Ontario. Sustainable Development Group, or SDG, is planning a significant project that could set a new benchmark in mass timber construction.
That's right, Sandy. This project is quite ambitious. SDG is looking to develop a 400,000 square foot 4-tower apartment complex along the Highway 400 corridor. It's expected to house over 1,000 units, making it the largest Canadian mass timber residential development by unit count.
The site is located at 35 Sperling Drive in Barrie, a city that's been growing rapidly due to its strategic location and more affordable housing compared to the Greater Toronto Area. This development, with its 18-story towers, will be built using mass timber components provided by British Columbia-based Intelligence City.
And it's interesting to note that the project will have a 2-story concrete base. Above that, the towers will be constructed with mass timber, which is a more sustainable building material. This approach not only supports environmental goals, but also aligns with SDG's mandate to use Canadian resources for housing construction.
Exactly, Steve. The project aims to create a community with approximately 330,000 square feet of leasable space, plus common areas and amenities. Kartik Singla, co-founder of SDG, has expressed their commitment to setting a precedent for domesticating the housing construction industry in Canada.
It's a commendable goal, Sandy. Intelligence City is already working on Toronto's tallest residential mass timber building and is planning to expand its manufacturing base into Ontario. They're even considering setting up a factory in Ontario to enhance local production capabilities, which could deliver up to 1,200 units a year by the end of 2026.
That's a significant development, Steve. And for Barrie, this project is a big deal. The city administration is supportive of growth, and Barrie's fast growth rate, coupled with a high median household income, makes it an attractive market for such a large-scale project.
Absolutely. The project's location offers a great view with the Little Lake area and the rolling hills of Oro-Medonte Township nearby. Plus, SDG is planning to include amenities similar to their Clapperton Village project, potentially integrating outdoor wellness features designed by renowned landscape architect Peggy Chai.
It's an exciting time for Barrie, Steve. With site work expected to begin in 2026 and construction in 2027, this development not only promises to deliver much-needed housing units, but also sets a new standard for sustainable building practices in Ontario.
And with that, Sandy, we've covered some significant developments today, from mortgage trends to regulatory updates, and now this innovative housing project in Barrie. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.